Hi, I'm Stuart Porter, Chartered Financial Planner. Today I'm talking about UK property as an investment following the autumn statement of the 17th of November. Following the market turbulence caused by Kwasi Kwarteng's statement in September, the autumn statement was widely accepted as prudent by the markets. However, there were several important changes which will have an impact on the UK property market. So let's start with interest rates. Interest rates are important as the majority of people borrow money to buy property. Even cash buyers are indirectly impacted. This is because where there is readily available, low-cost finance, demand will be higher, causing prices to rise. Conversely, where finance is scarce and costs are higher, more landlords will sell. This increases the supply of property and drives down property prices. A mortgage is comprised of two elements, the method of repayment and the interest rate agreement by which the borrower manages the cost of the loan. This may be a fixed rate or a variable rate. Kwasi Kwarteng's statement resulted in many lenders withdrawing their mortgage interest rate agreements from the market. This was at a time when the options for expat borrowers were already very limited. For borrowers whose mortgage interest rate agreement came to an end in October, the options for managing the cost of their loan would have been very limited. For some, this resulted in them paying the standard variable rate for a while. Standard variable rates for buy-to-let properties currently range between about 7 and 7.5%. Now, about 2 months on from Kwasi Kwarteng's statement, if you have a substantial amount of equity in your property, you may be able to fix the rate for under 4%. For those with less than 20% equity in the property, they are likely to pay more than this. UK base rate, the rate determined by the Bank of England, is currently 3%, but is expected to rise to average between 4.5% and 5% throughout 2023. It is widely reported that one of the reasons for the negative market reaction to Kwasi Kwarteng's statement was that the spending plans were unfunded. On the 17th of November, the new Chancellor laid out plans for financing those spending plans he had not reversed. So let's take a look at personal taxes. Whilst other forms of ownership do exist, such as owning property via a limited company, the most common method of ownership remains in the name of the individual buyer. There are three main personal taxes in the UK: income tax, capital gains tax, and inheritance tax. Rental income and capital gains on real estate in the UK are subject to UK taxation, even when held by an expat. Let's take a look at income tax first. When owning a property in the UK and where there is no other income arising there, the property owner can make a profit of £12,570 a year before paying any UK income tax. This is the UK income tax personal allowance. Historically, this has been adjusted for inflation. However, when he was Chancellor, the current Prime Minister, Rishi Sunak, froze many allowances at their 2021 rate until 2026. This was to pay for the costs of COVID. In his autumn statement, the current Chancellor has extended this freezing from 2026 to 2028. The threshold for higher rate tax has also been unchanged, and the threshold for additional rate tax was lowered by about £25,000, which means that many more people will pay the top rate of 45% on income tax. Assuming a landlord is already a taxpayer, this means that when they increase the rent on their UK property by the rate of inflation, they will pay more in income tax. This is because their personal allowance hasn't risen. As tax is effectively a charge made by the government, this makes investing in UK property less profitable. One of the reasons investors like UK property is the fact that it provides the opportunity for capital growth. So let's have a look at capital gains tax. One of the most radical changes has been the change in the capital gains tax regime. Currently, the capital gains tax exempt amount is £300 a year. Therefore, any chargeable gains made in the UK on real estate can be reduced by this amount before paying the tax. For basic rate taxpayers, the rate of tax is 10% plus an additional 8% for holding residential property, a total of 18%. And for higher rate taxpayers, it's 28%. This does not apply for properties which qualify for private residence relief. With effect from April 2023, the annual exempt amount will drop from £12,300 to £6,000, and from April 2024 it will fall to just £3,000. If you die before you sell your property, capital gains tax is generally washed away and replaced with inheritance tax. So let's take a look at that. Most UK expats based in the UAE will be subject to UK inheritance tax on their worldwide assets, not just those in the UK. So, your property in Dubai and savings overseas will be assessed for this tax too. Inheritance tax is a capital transfer tax charged at a flat rate of 40% on death after allowances, exemptions and reliefs. The inheritance tax nil rate band was set at £325,000 in 2009 and it's remained there ever since. As with the income tax personal allowance, the nil rate band is to remain frozen until 2028. With the allowance to be frozen for almost 20 years, it's no surprise that this is the fastest growing tax for HMRC. Whilst having a reputation for being a voluntary tax, this is quickly becoming a fallacy. In 2009, the average UK property price was £157,000. As at August 2022, it was £296,000. Therefore, an average home is scheduled to be worth more than the nil rate band in about 2 years' time. A few years ago, the residential nil rate band was phased in. This enables those bequeathing property an additional allowance. This allowance is set at £175,000. There are a few caveats to this allowance, such as the pool of potential beneficiaries and the tapering of the allowance for estates worth over £2 million. This allowance and the £2 million threshold are also to be frozen, which means that many people will lose the benefit of the residential nil rate band, assuming property prices rise modestly over the next 5 years. The dividend allowance currently enables all UK residents to receive up to £2,000 a year in dividend income before tax applies. Thereafter, tax is applied at either 7.5%, 32.5% or 38.1% on the excess over this amount, depending upon your tax bracket. The dividend allowance is to be cut to £1,000 with effect from April 2023 and £500 with effect from April 2024. Why is this important for buy-to-let property owners? Some investors have bought their property via companies and pay themselves dividends instead of rental income. Whilst there are other benefits to this structure, tax efficiency of dividend income is dwindling. Stamp duty land tax is another area of change. Buying property in the UK attracts stamp duty land tax. In September 2022, Kwasi Kwarteng increased the minimum purchase price before this tax was applied from £125,000 to £250,000. However, this only applied for owner-occupiers. Those buying second homes or investment properties pay an extra 3% unless it costs less than £40,000. On top of that, overseas investors such as expats pay an extra 2% with no lower threshold. So for most expats buying an investment property, they will pay an extra 5% on top of the standard stamp duty land tax rate, which ranges from 0% to 12%. The fundamentals of property investing are that it should generate an income in the form of rent and the potential for some capital growth. Borrowing to buy a property over the long term has worked for millions of people in the past, and that's unlikely to change. However, investing in property has several risks, which appear to be heightened at present. Transaction costs are high for expats. Taxes such as stamp duty land tax when buying and capital gains tax on selling are significant costs. The cost of living squeeze will cause market pressures which may cause rental income to be depressed. The rental return may not keep up with inflation, and rental payments may be missed by tenants who become unemployed. Interest rates are rising and increasing the cost of mortgages, and the cost of maintaining property will rise in line with inflation as skilled plumbers, electricians and carpenters are in high demand. There's increasing red tape in the terms of health and safety requirements, and the cost of certifying the property to be appropriate standard is costly and is probably best left to professional firms to ensure compliance. Finally, property is illiquid, and as we've seen over the last few years, property owners are easy targets for cash-strapped governments. It's not quick to sell a property, and there are costs involved in doing so. As the adage goes, property is all about location. The value of property in most locations in England has significantly increased over the last few decades. However, there are parts of the country which have not seen the same growth rates. Given the large amounts of capital required to buy property and the high transaction costs, care is needed when selecting your investment property. The latest date for a UK general election is January 2025. As at the 14th of November, YouGov predicted a Labour victory. How many of these changes in the autumn statement will actually remain in force until 2028 is unknown. Of course, with a little over 2 years to go, a lot can change. However, the economic reality for many of these changes is unlikely to change significantly. This video has only focused on the autumn statement changes and doesn't address the myriad other aspects associated with owning real estate. UK residential real estate will probably remain a popular investment with expats for the foreseeable future, but it does have risks, such as concentrating large amounts of wealth within a single illiquid asset. As an advisor, I encourage my clients to hold at least one property in their home country and to have a portfolio of diversified assets. This enables them to avoid the risks of being overexposed to a single asset or type of asset, such as cash, fixed income, property, shares or commodities, and capture growth across multiple markets. If you have any questions, please contact me and I look forward to hearing from you. And thank you very much for watching.